In this video, I want to go over some of the concepts behind the inherited IRA. What are some things to be mindful of as you're, crossing over this venture? Unfortunately, typically individuals that are looking up the term for inherited IRA are not really in a good situation because they just had a loved one that passed and they probably inherited that individual's IRA account. So I'm going to go over, some of the things, what to know, whether you're a spouse, a non-spouse, what's changed since December 31st of 2019, and then different problems and then solutions on how somebody could leverage an inherited IRA to accomplish their retirement need or just accomplish some sort of financial need by looking at this account in terms of an asset. So, essentially the situation behind an inherited IRA is you have an individual that has a traditional IRA account and they've unfortunately passed away. So if that individual named a specific beneficiary or multiple beneficiaries, they could either be spouse, they could be non-spouse, they could be charities. For the most part, I'm just going to talk about spousal versus non-spousal. So based on the category that you're in, it could make a little bit more sense to you. But ultimately, we take a step back, think of this asset like a bucket. So as an IRA account that was in the individual's name, that sort of bucket was growing by the contributions the person was making and the rate of return that was coming back within this plan. When this individual passes away, now this IRA account can get transferred over to the person that they named as their beneficiaries. So with a spouse, one of the first ones is obviously a spousal benefit. The spouse has a couple of different options. This spouse could either roll it over into their own name, so they could take possession of it as if they were the ones that originally created that IRA account, or they could do something known as create an income stream known as required minimum distributions. So the reason why RMDs are very important to note is with a typical IRA account, it's a retirement plan, so it's a qualified retirement plan. What happens is this bucket, once again, it grows by the contribution somebody's making into the plan and the rate of return that somebody has chosen based on their different investment options or whatever sort of accumulation strategy with this bucket. The good news of this is obviously the more that somebody's adding into the bucket, the more this account's going to grow. The more that they're going to get a higher rate of return, the more this account's going to grow. So this bucket was getting fatter and fatter and fatter. As the person was living, that bucket was accumulating, based on the performance of, how they had that account structured. Because it's a qualified retirement account, it's deemed that an individual cannot take monies from this IRA account before the age of 59 and a half. So that's the minimum. If they try to remove dollars from this sort of account before age 59 and a half, then they would get dinged with full taxation and also a 10% penalty. So really the main reason why is just that 10% penalty. Now, if let's say they took it after 59 and a half, then all they would do is just have to pay full taxation on whatever they pulled out of it. So that's one side of the coin. So basically between a rock and a hard place, the rock being the 59 and a half rule, the hard place being a required minimum distribution. Now, it used to be 70 and a half. RMDs were 70 and a half for a very long time. There was a recent change. Well, now RMDs start at age 72. So what that means is when somebody hits age 72, the IRS is forcing them to start taking out distributions. Well, why do they force them to start taking out distributions? They force them to start taking out distributions because the government will tax them on those monies. They're not just allowing them to grow tax deferred. They're saying, okay, well, maybe at 72, you have to pull out 3% of your money. At age 73, it's 3.6. At age 74, it's 4.5. So that it's going to be an increasing scale each year off of what your overall account balance is in your IRA account. So be mindful, that's how an IRA account works. Now, when you have an inherited IRA account, it's a little bit more flexible with those options. So if we're talking about it from a spousal standpoint, first option is that a spouse could take monies from the inherited IRA and could turn it over into their own IRA. So let's say that they had an existing IRA that was already established and it was sitting at a $100,000 balance, and they inherited from their spouse $200,000 that was sitting in his or her IRA. They could take those monies and now, roll it into their existing IRA that's now sitting at $300,000. So it's now going based on their own name, their own social security number, all of that. And that way on how that rollover worked was because it was through an inherited IRA. That's what gave them access to obviously that $200,000. But now it's all based on what their age 59 and a half is, what their 72 is. So like, if let's say we had the husband was the one that passed away and he's age 69. If he was still living at age 72, he would have to start taking out required minimum distributions. It's only a 3-year spread. Versus the wife, let's say the wife is age 61. she decides rather than keep the money in a beneficiary IRA or inherited IRA, so that she's going to have to start taking out distributions as if this individual is still living, she's taking all the monies, placing it into her own name. So now she has 11 more years before she hits age 72 to start, leveraging that required minimum distribution, rule. So the RMD used to be at 70 and a half, and then it was changed in December 2019 to age 72. So it allowed individuals to have a little bit more flexibility there. Now, also what changed was an individual, a non-spouse, had more flexible options where now those options are restricted. So what do I mean by that? The first thing, and really the most important thing, is non-spousal beneficiaries may not treat an inherited IRA as their own. So unlike the other situation where a spouse could say, yes, roll it over into my own name, or leave it within the inherited IRA, the beneficiary IRA, non-spouses do not have that option. So prior to December 31st, 2019, a non-spouse beneficiary had a flexible component where they could create a beneficiary IRA as if that individual was still living and leverage their age 59 and a half to, take dollars, leave it in the account, leave it to accumulate, even if that non-spousal, that non-spousal beneficiary was below the age of 59 and a half. Now, with the new change, is the IRS requires that this individual has to take out monies within 10 years from when that individual passed away. So they have to start taking out distributions. When they take out distributions, they're going to be taxed on those monies. So they can either take it out in the form of a lump sum, but everything has to be liquidated within 10 years. Now, some heirs are exempted from this rule, such as disabled or chronically ill individuals, minor children. Also, if, let's say, the beneficiary is within a decade, so within 10 years from the same age of the person that passed away, that's where they have a little bit more flexibility. But typically, individuals are going to fall into the realm of that 10-year rule, meaning that they have to start liquidating their monies within 10 years. Now, they're not going to get dinged with that additional 10% penalty like you would with a typical 59 and a half rule, even if they're below the age of 59 and a half. But the government's going to force them to start pulling out those monies, taking distributions, because every time they're taking out a withdrawal, they're going to be taxed. So the government's able to get their tax on those dollars. So that's just something to be mindful of. So the spouse, obviously, they have the flexibility to roll it over in their own name. They have the flexibility to take out required minimum distributions, as if that spouse was still living, to just inherit it, to have something known as a beneficiary IRA, where you can take it over as if that person was still living, and then make sure that's accumulating that way. So the spouse has a lot more flexibility there. The non-spouse basically says, unless you don't hit any one of those other qualifications that I mentioned, you have to start pulling out these monies. You could take it in the form of lump sum, but it has to be liquidated within 10 years from when that person passed away. If you were subject to before December 2019, well, then you're grandfathered into those old rules. So this is for individuals that obviously have received or have been beneficiaries of an IRA. This is what the rule changes have been. So obviously individuals that came to that circumstance before December 2019, you're still grandfathered into those rules. Those rules do not change. Some of the most common problems that we see with inherited IRAs is individuals might keep that as a beneficiary IRA, but they cannot add contributions into those accounts. So let's say if you have a spouse that they're leaving it in, the spouse that passed away, they're leaving it in their own name, and that person's name as an inherited IRA, they cannot add extra contributions into that plan. So they just basically have to keep it in there and then leverage anything on the rate of return side. So if we think of that like that bucket, and the bucket grows by contributions and rate of return, well, there's no more contributions being made to this bucket, so now it has to stay by just trying to accumulate, whether that be investments, fixed accounts, fixed index accounts, however that case might be. So typically it makes sense for the individual to place it over in their own name if they are a spouse, and then make sure that everything's customized to what their goals are. As their spouse passed away, maybe you have a decrease in your budget, because there's less expenses there for two people as opposed to just one person. Also, you might have more flexible options based on that person's age, so everything can be customized based on their state, based on their age, based on the time horizon before they want to start pulling out monies, whether they want to take those monies as an income, just as an accumulation, if they want to leave that as also inheritance to beneficiaries, to kind of leave it as a type of legacy account, how all of that works. Also, when you have the monies over into their own IRA, then you could go and do Roth IRA conversions in there, so it makes that flexibility a little bit better. The non-spouses, unfortunately, they're just subject to take those monies and just know that when they pull out those dollars, take out those distributions, they could either take it out where, they're pulling out 1/10 so that all, basically for 10 years, it's going to be liquidated by the end of from, starting date 0 to the 10th year. Everything's going to be liquidated within those 10 years. So they could set up something more systematic to stay under the radar based on what their tax bracket is. Or they could go and take it in form of lump sum, pay the taxes all at once, and then leverage those non-qualified monies after it gets liquidated to cash. I'm going to go over 2 examples that happened personally with clients. First situation's kind of a fucked up situation. I don't mean to curse on this, but I was dealing with a client I had for many years, and I was talking to him over the phone. He was going down to Mexico, was to enjoy an anniversary with him and his wife. And last thing I said to him was, okay, well, good luck down there. Hope the cartel doesn't kill you off. I'll see you in a week. And unfortunately get a phone call from a family member that he was having a steak dinner, had a heart attack, healed over and died right at the table, probably within 24, 48 hours from when I hung up with them. Story is kind of irrelevant, but what happened in that situation was we had multiple IRA accounts. We structured his financial plan to make sure that everything was customized effectively. Now, the wife was one of these people that he handled everything. She didn't know what to do. All she knew was she went to work every week and, brought in a paycheck. And she's like, okay, I kind of want to stop working in the next 3 years, but I don't really know what to do. So what we were able to do is he was a little bit older. He was going to be taking required minimum distributions, but she wanted to leverage everything over in her own name. So what we did was we created an income strategy, we created an emergency strategy, and we also created a growth strategy, the 3-thing scenario. With her income strategy, because the individual passed away, she was now eligible to have a step up in Social Security income because it's going to be the higher of the 2 between the individual and their spouse. So she was able to, and she wanted to trigger it at age 65 to trigger Social Security income. She was 62 at the time, also had dollars that were sitting in multiple IRA accounts. What we did was we created an IRA that was set up to produce lifetime income with a 3-year deferral. After doing her budgeting analysis, we said, okay, this is what your expenses are now, because obviously your husband is no longer living. This is what your expenses are now. This is what we're projected that's going to be in 3 years when you stop working. So she was able to still work, still contribute to her own 401k account. But we had this IRA that was sitting in her name that was accumulating for the next 3 years before we started triggering a lifetime income rider. One of the specific products to do this was a fixed index annuity with an income rider that was set up for a 3-year deferral. So in 3 years, she was able to trigger it, and it was the combination between the income that she was receiving from the IRA that we customized for that income stream and the Social Security income was enough to accomplish what her expenses are. Now, the money's left over. We had an IRA that was established in a money market account for emergency needs. She's 65. She starts collecting income because she didn't have pension through work, but she started collecting income from the IRA annuity, and she was collecting income from the Social Security income. Dollars that we left over for her was basically we calculate. There's a few different ways on how somebody could create an emergency fund. It's based on really what their current lifestyle is, and also what their occupation is. So like if somebody's in a riskier occupation where maybe money's going to fluctuate each month, you might want to have more monies in liquid savings as opposed to an individual that, let's say, has more stagnant income, more, salary type income that we know there's not really going to be flexibility, volatility within their income status. So that's typically 6 to 12 months of what the expenses are. That's where we want to make sure that's staying within that emergency need. So IRA number 2 was created to leave about 6 months of whatever expenses were in case of an oh my gosh moment that she had to pull from. And we had the bulk of the dollars are now sitting in combination of IRAs. One was setting up with an IRA with different investments based on what her risk tolerance was, based on the time horizon. We had an IRA that was set up as a type of legacy play to make sure that it was set up for inherited for her beneficiaries, for her son. And then we had another one that was just mainly set up as a fixed account. So what we did was we took the multitude of that, my client's IRA account, when he passed away, we had it spread over into her name. And now she had that flexibility to go and create customized IRAs specific to her needs, specific to her goals. And we fit it like a perfect puzzle piece for her situation. If, let's say, she would have kept it in his name, it could have been a sticky situation because she didn't need the money. She didn't need that extra income within the next 3 years. She wanted it to be, specific for those next 3 years before she started triggering income, and we made sure to structure everything over in her name, and it made things a lot easier. So that's obviously going over the example of the spouse. Another example was with a non-spouse, meaning one of my clients that their mother passed away. He was younger, he was in his 50s. The mother passed away, was in her 80s. He inherited some IRA accounts. Now, because he inherited it and she passed away after this 2019 date, he had to take it over in the form of distribution. So we had to measure, okay, what is his current adjusted gross income? If he was to take the monies in the form of a lump sum, how much would that push him over the next threshold to throw him into a higher tax bracket? So you have to be very careful with that. So we created different systematic options where we took 1/6 of his money and we're making sure to still do distributions of these dollars so that 1/6 is getting poured out, getting poured out, getting poured out, and then it's going into non-qualified accounts, and then we're leveraging those non-qualified monies to stay within the consistency of distribution plan, investment plan, estate plan, and a tax plan. Over to make sure everything's working most effectively, most efficiently. So it's just slight differences between the non-spouse and the spouse. Be mindful of what those rules are. If you need any help, obviously you could give us a call, 1-800-566-1002. You could reference this video, or obviously you could look up online, look up different publications. But it's very important to note because people constantly make the mistake, or they might be looking at older publications and saying, okay, well, this was how the rules were, before 2019, which I have clients that inherited IRAs before that standpoint. It was a lot easier to be able to take the IRA, the inherited IRA, the beneficiary IRA, keep it in that person's name, and then actually start taking out distributions as if that individual was still living. So it's a lot different of a ball game now because those changes that were made with the Secure Act after December 31st of 2019. Really the takeaway of this is you could leverage this. If you think of the inherited IRA as an asset, and then you look at what your goals are, so think of this like a bucket, then you look at what your goals are. You're saying, well, I actually might not have to, save as much money because I could use this asset for my retirement needs or my legacy need or my vacation slush fund or, purchasing, an extra house, an extra condo, whatever that is. So there's different ways on how to skin that cat. Don't just look at it as, okay, just this lump sum that I'm not going to be concerned with it. You could give yourself a lot less stress, or you could accomplish your need a lot quicker with your retirement planning need by knowing that this inherited IRA is either going to be there for you, or if you inherit it, how to take it out properly. So that's the thing is, use for your planning needs. Make sure that you at least have a plan in place, not just a portfolio. And that's obviously something we help out with. I hope you found some value in this video. It's just some different things that have happened. I've dealt with this with multiple different clients. It's not often, but probably a few times per year, I'll deal with inherited IRA situations with just personal clients, if not individuals that are calling in because they don't know what to do. They just inherited this IRA. And that's really where I think we'd provide the most value is, if you do have that situation, you inherit an IRA, you want to see what your options are, you want to try to create a customized plan, that's obviously, where we could help benefit you, or at least put you in the correct trajectory to either do it yourself or, leverage our professional opinion on some things. But if you have any questions, feel free to reach out to us. Feel free to visit our website, retiresharp.com or fosseyfinancial.com, and be sure to subscribe to our YouTube channel, Retire Sharp, so you have access to the most updated videos. Thanks so much, guys.